So welcome everyone to today's webinar. This webinar is on risk management and risk modeling. And we're going to be talking about something that's what I find to be an overlooked subject. And I really find it to be the base of applying risk management to your trading. I would say this is kind of the path or the corridor you really need to go through and to really develop a solid risk model. And that once you have gone through this, understand it, have applied it to your trading, then you'll really have a good hold and grasp of what's going on with your trading and your risk management. But if you haven't applied this, wow, it just keeps doing that. Until you apply this though, sorry, I was just looking at some comments there, my apologies. Until you apply this though, you could be, without even know it, using a risk management model that will lead to you blowing up your account. And I would be willing to bet many of you probably didn't even know that the current model you're using would actually mathematically have a high probability of leading to you blowing up your account. And when it comes down to it, risk management is Gabriel says, I can blow up my account even without a risk model. Nice. So when it really comes down to it, when working with mathematics or risk management, you really are just working with mathematics. And there are many ways to skin the math sheep or the risk model. There is no one correct way to apply a risk model for your system. You have to really understand risk management in terms of context. So using the blind 2-to-1, 3-to-1, 4-to-1, whatever model it is inappropriate or not necessarily useful without the context of your trading and your system and your model. And it's absolutely critical. It's important that we move beyond looking at risk as a two-dimensional thing, and we need to start looking at it in 3 dimensions and even in 4 dimensions. And I'll explain what those are as we go on. Now, I want to begin this webinar with a question. And before I do begin with a question, I want you to feel comfortable asking questions. So if you do have questions, feel free to ask them at any time. We're going to be going into a subject not often talked about, yet it could be the one thing that you need to fix to turn your trading from semi-profitable or treading water to profitable, or from making a little bit of money to making a lot of money, or from making no money to making money. It could be the one thing, and I would be willing to bet with most of you, if I had to narrow it down to 2 things that are separating you from success, it would either be psychology or be risk management. And so, and if it's both of them, then you're in trouble. But it also means it just means you need to work on more, and those are things that are totally fixable. So, with that being said, feel comfortable asking questions. And with also that being said, I want to get into, and I want to begin this webinar with a question. It's kind of a rhetorical question, but I still want to ask it anyways. If you had a choice between a system that was 70% accurate and a system that was 30% accurate, which one would you choose? I know which one I'd choose. I'm pretty sure I know which one you guys would choose. But I just want to hear it anyways. I know it's a rhetorical question. I understand it's kind of a silly question. Okay, so Greg's saying not enough info. Jerry G says depends on return. Gabriel says 70%, of course, 70%. I didn't say anything else. I just 70% accurate or 30% accurate. If you had a choice between the 2 systems, given no other variables, what would you choose? 70% or 30%? Given no other variables. So I can't give you any information about wins, losses, RRs. Gam says, haha, I would. Depends on the hit rate and reward produced. Okay, so you have to play along without any other variables. What would you all choose? Everybody would choose, it seems like everybody chooses the 70%. Now here is something interesting. This same question was posed to a series of professional traders, and they were actually given the same information you were. It was 70% or 30%, and they were given no other additional variables. None. No other information about risk to reward, any of the other details whatsoever. They were given no information about it. And their answer was this. They all answered 30%. Every single one of them. Why do you think they all answered 30%? In response to Fernando's question, they assumed a 70% strategy was very short term. No, they didn't. They actually asked them and surveyed them after and said why. They didn't think it was a trick question. They all had to answer why. Let's see here. Gam says assumption of larger RR, less stress. Okay, some of you are hitting close to the target, but you're not hitting the target per se. But here are the people that are close. FX Work says on 30% systems, it's likely you can get higher R to R. Assumption of larger R to R, less stress. 70 will have wild swings. 70% system doesn't have to have wild swings. Why does a 70% system have to have wild swings? I could create 6 different models of systems that are 70% accurate, and some could have higher swings and some not. And remember, we can't make any assumptions about the 70% system. Okay, I'm looking at some of the answers here. I'm more conservative because I want to take advantage of inefficient market. Nothing to do with inefficient market. They don't believe they can have something big. Nothing to do with that. Less money at risk. Nothing to do with that. Neither of these, you could have the same money at risk with both systems. Here's the thing about it. They all chose 30% because they realized that a system that was profitable, if you had 2 systems that were profitable, one that was 70% accurate and one that was 30% accurate, they realized that the 30% system must have some inherent qualities inside of it to make it more profitable with less accuracy. They realized it must have had some underlying or inherent qualities that allowed it to be profitable by being only 30% accurate. And that's interesting because when you ask retail traders across the board, if I was to go sample 10,000 other retail traders, I'd be willing to bet that the numbers would be overwhelmingly 70%. There was also another thing about it, is that institutional traders, especially with long track records, are a lot more confident in their trading. So they don't need to augment their lack of confidence with higher accuracy. This should be informative to you that it is possible you're looking for a seriously high accuracy system because you're trying to augment your lack of confidence in your ability to trade. They weren't. Psychology wasn't an issue for them involving that. And when you remove the psychology from it, they thought about it with a clean head and said, well, the risk management on the 30% system must be far superior and it must have qualities inside of it that make it a really good system. So hopefully that will implant something in your mind. Hopefully implant two things in your mind. That maybe your search for a high accuracy system is more about augmenting your lack of confidence than it is really about being able to trade profitably. And hopefully the second thing, and probably more important and in line with this conversation we're having today, is that when you look at systems, you want to look at, does it have underlying risk characteristics that will make it a really powerful model? Because those underlying characteristics will work for you far better in the long run, and in not just good times, but also bad times, than having a system that is 70% accurate as a whole. And so hopefully this will really get you to start thinking about risk in a different way. Now, we're going to get into three-dimensional risk modeling, and then we're going to get into four-dimensional risk modeling in a moment. But I have another question for you, which is, how many of you have 3 months trading? It can be demo or live. And then how many of you have been trading a system demo or live for 6 months? How many of you would fall into the 1 year category for that same question? And then how many of you would fall into 1+ years of trading that system? So go ahead and type in the number that you are at. Pavel says 1+, Fran says 1+, Pip says year, 2 years. Laser and Pablo say more than 6. Wow, interesting. Okay. I'll have some questions for you guys later. Same system, Pablo, for more than 6 years? I don't just mean overall trading, I mean the same system. Okay, so I'm talking about at least one system. It could be, you could be trading multiple systems, but pick one of your favorites. Pick your favorite. And then how long have you been trading that? Is it 3 months, 6 months, 1 year, plus 1 years? So you might have to retype that in. If you do, go ahead. Okay, seems like we actually got a pretty good bound of experience here. 6 months, 1 year, couple years, 2 months. Seems like I change every month. Okay, job is, take note of this. You're gonna really want to pay attention to what we're getting into here. So I talked about a path or a corridor that you have to walk through in terms of risk modeling. And this is, I believe, the thing that you have to pass through before you can really nail down your system, your risk modeling for your trading. It's called the risk of ruin. If you've heard of it, cool. If not, I'm going to explain it. I wish they'd actually rename it because the risk of ruin sounds so negative. But here's the formula. The risk of ruin formula is really built to communicate, hey, if you are risking X percent, 1, 2, 3, 5, 10, 20% per trade, and you are X percent accurate, as it shows here in the Excel sheet, and then here's your payoff ratio, 1 to 1, 2 to 1, 3 to 1, 4 to 1, 5 to 1, it actually mathematically calculates the probabilities that you will blow up your account. Now, because of this, I think it's bad PR. I would rename it the risk of success or something like that model. And I think it would actually become a lot more popular. But most people, when they look at risk reward, they just think of, hey, I'm 2 to 1, or I'm 3 to 1, or I'm this, or I'm that. That's two-dimensional thinking. You could be 5 to 1, have a 5 to 1 R to R ratio, reward to risk, and you could still blow up your entire account. That may seem impossible, but it's a mathematical fact that it can be done. And so this is why I always say, hey, if you're going to be trading a system, you want it to be as much rule-based as possible. Ideal is that all the rules are laid out for trading. Because if all the rules are laid out to enter and exit a trade, then we can measure each individual variable and see how it's working, and we can test the system as a whole. if it has three variables, A, B, and C, to enter a trade, and then we adjust, say, C, we can see, does it improve the accuracy? Does it reduce the accuracy? Does this improve the payoff ratio? Does it decrease the payoff ratio? But because we have all these variables laid out, we can then model it in terms of risk. If you're trading a purely discretionary system, it's not the end of the world. You just have to be able to break it down into as many rules as possible, and then you need a really large data set to figure out, hey, is this model mathematically going to make me money, or is it mathematically doomed so that I will blow up my entire account? Because if I'm willing to bet, if you found out that your trading system, no matter how much you like it, is mathematically doomed to blow up your account, you would either adjust it or abandon it immediately. I'm pretty darn sure of that. So with that being said, that's why you need to understand this risk formula, this risk model called the risk of ruin. It's three-dimensional risk. It includes risk to reward plus accuracy. Risk is first dimension, reward is second dimension, accuracy is the third dimension. Now, let's explain how it works itself out. I have a very clever programmer who was able to build me this little program that I can literally just click on it, type in the percentage that I wanted, and it will pump out these numbers into an Excel sheet for me. Super great programmer, hats off to him. Now let me explain how it works out. Here is the payoff ratio, or the risk to reward. And it's actually, sorry, it should be reward risk. So 1-to-1 is my target is 100 pips, my stop's 100 pips. 2-to-1 is my target is 200 pips, my stop is 100 pips. And on and on and on. 3-to-1, 4-to-1, 5-to-1. What it does is it says, okay, pick a percentage that you are risking per trade of equity. I'm risking 1% or 2% or 3% or 5%. Any amount that you want. And then it'll tell you, based on the accuracy of your system, then once you know the accuracy of your system, then you can really find out, hey, is my model mathematically going to make me money or lose me money? And I'll get into your point in just a second here. Now, how many of you actually know the accuracy of your system? For those of you who said 1 month, 3 months, 6 months, whatever. How many of you know the accuracy of your system in regards to you've been trading it? So you've been trading your system, your favorite system, for X amount of months or years. How many of you can tell me right now with pure 110% honesty that you know the percentage accuracy of your system? Fernando says you do. Okay, Fernando. How long have you been trading the system? Okay, 55% accurate. Really? You've done the data? You've done it and it came out to 55 even? It didn't come out to like 55 or anything like that? And no like percentage 0.23 or something like that? Approximately 55%. Okay. Jonty says 65, 5404. You really know that chaos theory? 54.04%, 62 plus? Okay, so the people that are answering, you're saying, hey, I know this number statistically. I've done the testing on it. Is that correct? So for Fernando, Jonty, Dorix, chaos theory, Ganster, Gabriel says 30% on 75 trades. Okay. All right, great. This is fantastic. Here is why you need to know the accuracy of your system. Let's take any one of you. Let's take Jonty, the first one. 65% accuracy. Let's explain how the model works out. If you are 65% accurate and you have a 1-to-1 reward to risk on your system, this number right here represents the percentage chance that you will mathematically blow up your account. 4.53%. Pretty low. So if you are 1-to-1, then you're in pretty good shape. If you're 2-to-1 or higher, you have less than a 1% chance. Where do you want to be in this entire list of things? You want to be less than 1%, and ideally 0%. You want to be in a position to where you can say, I have a 0% chance of mathematically blowing up my account based on the data I have on my system, knowing I have a pretty large data set on my system, I know the historical accuracy of it, I have a pretty good distribution and know where all things lie out, and based on all that information, I can say I have a 0% chance that I will blow up my account. Now, what would happen if Jonty went from 65% to 55%? Just a 10% drop in accuracy. His percentage chance that he will blow up his account goes from 4% on a 1-to-1 R-to-R to 36%. That increases, that's an increase by over 900%, roughly. 900%. He has a 36 chance of blowing his entire account, basically a 1 in 3 chance he's going to blow up his account, based on the current system he's using and how it's working itself out. Now, here's an interesting question for you that you should be asking. For those of you that know, let's see, Jonty, Dorix, Fernando, Chaos, Ganster, Gabriel. Okay, you and Gam, you guys know exactly your accuracy ratios, which is a very good step. Now, let me ask you this. Are your targets fixed? Or is it a fixed target every single time? You know, it's exactly 50 pips, or it's exactly this, or it's exactly that. Okay, Jonty says no, Ganser says no, Fernando says no. Okay. Chaos Theory says fixed every time, trailing stop. Very good. Gam says I have a fixed minimum. Excellent. Now here's an interesting question that for those of you that know it's fixed, and then for those of you that don't know it's fixed. Let's say you have a model that is 50% accurate and your normal target is 2-to-1. You have about a 9% chance of blowing up your account. Pretty low, but it's definitely out there. Now, what happens if you don't have a fixed target? Let me ask you this. How many of you that have a system and have a target based on that system adjust the target? In other words, take profit before. Let's say you have a target that is 50 pips. Do you perfectly take profit at 50 pips every single time? Or do you take it a little bit early? You might maybe let it run. Maybe you take it a little bit early. I would be willing to bet if we took a distribution, you'd probably be taking it more early than you would be taking it past your 50 pip target. So for those of you to know, how many? Jonty says, sometimes that's a problem. I'm taking too early. Guess what? If you start taking it too early, your numbers start to blend into the 1-to-1. Now, depending on how much you do it, will depend on how much you blend into the 1-to-1, but you could be going from 9% all of a sudden to 50%. That could be absolutely disastrous to your account. A 1 in 2 chance of blowing up your account. So now you can see mathematically the disastrous effects of A, not following a system, of B, not knowing how accurate your system is, C, not knowing where you are in the distribution, and D, taking profit too early. Gam says, I never take early. I have my rules and targets and I stick to them. Good. For that, Gam, definitely hats off to you. Takes an immense amount of discipline and training to do that. Fernando says, does not seem like a good idea. Why a given amount of pips? It could be for whatever reason. Maybe you've done plenty of statistical modeling on your system to know that, hey, I over 70% of the time, I can get 30 pips or 50 pips out of this trade. Maybe you've done 10, 15, 20 years of data studying, pretty large data set. Depends on the system. There are some systems that will be served best by having a fixed profit target. There are some systems that are not, that will just be best served by saying, hey, here's the stop. The stop is 25 pips in this case based on the model, so my target has to be 2 times that or 3 times that. So it depends on the system. But does everybody see how changing the profit target can have a disastrous effect on the chance of you blowing up your account? Does that make sense? Can everybody see the mathematics behind it now? Great. Now, let's get into a couple things here. Dry Desert has a question. Chris, doesn't the percentage depend on the position size as well? Absolutely, which is why we're going to go over various numbers to show you how they're loaded within this chart. And somebody said something about this, the zeros seem to be weighted, should be 0.001. Well, eventually it will be 0.0. It will be 0%, but the ones that were 0.01, you know, we just said, forget it, let's just make it 0. Look how, if you're risking 20%, this is based on 20% capital at risk. Now look at how heavily loaded this is. You know, if you're 1-to-1, you have to be a minimum 55% or better to not be mathematically sure you're going to blow up your account. You get to 2-to-1, you have to be at least 45% accurate or better, and if you want to be 0, if you want to have a 0% chance of blowing up your account, you have to be 80% accurate, risking 20% of your capital per trade. Look how the distribution changes as we go into profit targets. So this shows the power of being able to build a system with really good profit targets. Now, let's take a look at what happens when I change this model to 10%. So I'm going to pause the chart, close that up, and then I'm going to put up 10%. And then you're going to see how the distribution changes tremendously. 125. Okay, and let's go to chart again, and bam. Now 10%. Let me know when you guys see it. Great. Okay. Take a look at how this distribution changes tremendously. It goes up way higher. So to get to 0, you don't have to be 80% accurate. You just have to be 65% accurate, risking 10% of your equity per trade. So just by reducing the equity per trade in half, you now have to be 15% less accurate. That puts a much lesser burden on your system. That's for a 2-to-1. You go to 3-to-1, and it puts even lesser burden on your system. Now, let's take this again and go down to 5% and see how the burden is. But to be, look at this here, at 10%, you only need a 2-to-1 R to R at 45% accuracy, and you will have a 3.41% chance of blowing up your account. That's pretty manageable for most people. 45% accuracy, 2-to-1 R to R, pretty manageable for most people. But let's see what happens when we reduce it to 5%. And then you will start to see how important it is to be risking a lot less per trade. And hopefully you will start to see, wow, I really need to know the accuracy of my system. Because I may be blowing up my account no matter what. Here's the new one. 5% per trade. Look at what happens here. There's only one variable that is not 100%. It's either 100%, this, or 0. At 55% accuracy, if you have a 1-to-1 payout ratio, and you have 5% capital at risk, you have a 1.81% chance of blowing up your account. As soon as you hit 60% accuracy, you have no mathematical chance of blowing up your account. But take a look what happens if you're risking 5% capital and you're now at 2-to-1 R to R. You have less than a 1% chance of blowing up your account if you can be 45% accurate and have a 2-to-1 R to R. So can you now start to see the power of risking a lot less per trade? How much reducing your risk just by a few percentage points can mathematically put you into, I'm going to make money for sure, or I'm going to blow my account. Can everybody see the difference and how critical it is to not be risking large amounts of capital per trade? Harley says, tell that to the banks. Yeah, that's another discussion. I really wish they would. The banks are leveraged. Most banks are leveraged like, yeah, it's disgusting. It really is disgusting. That's another conversation. So can everybody see the power of this? Yes, no? Can everybody start to see the power of how important it is to know what your accuracy is? All right, let's look at the traditional 2%. We actually are between 0.5% and 2%. And when I say we, I'm talking about our fund. Okay, great. Do you guys still see the new chart? Should be the new one. Yes, no? Okay, great. Now look at the 2% model. If you have 2% at risk, you're 50% accurate, and you have a 1-to-1 payoff ratio, you have a 100% chance of blowing yourself up. But as soon as you hit 55% accuracy, you have 0% chance of blowing yourself up. Look at it when you have 2-to-1. If you are 40% accurate, risking 2% per trade, you have a 2-to-1 R-to-R, you have a 0% chance of blowing yourself up, which means mathematically you're going to make money. Interesting, huh? Once you start getting to 3-to-1s, you need only to be 30% accurate. Now, I want to show you, we've been getting requests for 0.5%, so I'll show you the 0.5%, and then we're going to start taking a couple questions, and then I want to show you a different model for measuring risk. So let me delete this one. Okay, I didn't run a 0.5%, I ran a 1%, so hold on a second here. Let me enter the percentage, 0.5. Percent key to continue, bam. There we go, I should have it. Okay. God, I love my programmer. Okay, here we are with 0.5% capital at risk. And look how the distribution curve works out. If you have a 2-to-1 R-to-R, and you are 35% accurate, you are mathematically, it's impossible to lose or to blow up your account, and you will mathematically make money. Everybody see that there? Yes? Are you guys seeing the 0.5% or no? Okay, great. So, can everybody see the power of how the mathematics can play in your favor or completely go against you? Can everybody see the power of no longer thinking in the traditional 2-to-1, 3-to-1, 4-to-1? 2-to-1, 3-to-1, 4-to-1 is meaningless without accuracy. And then once you have accuracy, then you need to find out, hey, where's my general distribution of this? Once you have all that down, then you can really decide, this is how much I should be risking per trade. Because then you can determine mathematically, am I going to make money or am I going to lose money? As soon as you get into that 0% category, you are mathematically going to make money. Hopefully, you can also see how important it is not to adjust your targets. Because once you do, again, you're putting them out, you start to take the mathematics against you. You really start to work them against you if you do that. And so it can have disastrous effects on your trading by not by adjusting your profit targets. Okay. With that being said, I want to get into a few questions, and I want to save about 10 minutes for another way of modeling risk. So let me see where we're at. Gamber says, how much this chart changes lowering the capital at risk to, let's say, 1 or 2%? Okay, I think we've answered that question, Gabriel, there. Swerve the Plumber says no scalping. It really depends on your definition of scalping. But, if you're talking about scalping 5 to 7 pips, mathematically, you're going to need to risk very, very little, and you're going to have a pretty high degree of accuracy to make that profitable. Because you're talking super small targets, you still got to account for the spread. Let's say a pip on your $1. If you're talking 5, 7 pips target, let's say you're targeting 7 pips, you're really targeting 8 pips because you need the 1 pip to cover the spread. How much can you really survive, in terms of a stop? 5 pips on that? So you're talking 5 pips plus the pip you paid, so really 6 pips. So you're going to have 6 pip stop, 8 pip target, which is barely over 1-to-1. You're going to need to be risking very small amounts of capital, and you're going to need to have high degree of accuracy to make that profitable. And then you have to think of how many trades you actually have to do that to actually make some money on that. If you're only risking 0.2%, you're going to have to trade a lot of trades just to actually make some decent money. So, it really depends on your definition of scalping. But hopefully this will illuminate the mathematics behind it and why scalping is, and when I'm talking scalping, I'm talking like less than 7, 8 pips. But why scalping is very hard to make profitable because you can see the mathematics behind it. Okay, Ganser says, trying to get the average win versus the average loss, then you get the real R to R. You need to get the average win, average loss, and then you need to know the accuracy of your system. Otherwise, you really don't understand your risk modeling. That's absolutely critical. Johnny Harley says, so not so extreme at 5%. Yeah, but you also have to consider it's not as extreme. But again, even at 2-to-1, you still have to be relatively accurate. And on top of it, if you adjust your target once or twice or 5 times in a month from 2-to-1 to say 1-to-1, that throws your mathematics off tremendously. So there's a lot less room for error. If you are still in the developing stages, I recommend being between 0.5% and 2% at a max. Only once you have a really good data set of your system, you've modeled it, you've tested it, you have a really good distribution of it, you're confident. Once you have all these things in place, then you can start to play with risk a lot more. But until then, why do anything to throw the mathematics against you? It's just not worth it. Johnny says, how many trades in the future are factored in this formula? Or is it some kind of mathematical convergence in infinity? It has nothing to do with the number of trades. You can do this without number of trades. So, let's see. Can you do it? Harley says, must we discipline their capital standing in? Exactly. Try and Trader says, it must be a lot easier when it is not your money to trade in larger amounts. Yes and no. I guess that depends. For example, if you're trading, say, 150 standard lots and it's your own money, you're taking all the brunt of that. If it's 150 lots of your client's money, then it could be a lot easier. But at the same time, it also could depend on psychologically how your mind works. You might actually have a harder time accepting risk for clients and have an easier time accepting risk for yourself. So it might be easier to trade larger funds when it's you, but then you might actually be psychologically have a little disposition of trading large amounts when it's your client's money. Maybe guilt or other issues like that come in. So it depends on the psychology trader. It's not a one-way street there. Cam says, do you have a chart which shows how RR changes for a given win ratio as capital risk increases? Compelling image. Do you have a chart for which shows risk of ruin changes for a given ratio? I don't have a chart. I need to get my Excel guy to work on that, so I apologize. Dry Desert says, do you agree to the common suggestion that anything above 5% risk per trade is gambling? No, I don't, because if you have the mathematics in your favor and they show that you have a 0% chance of blowing up your account, then I wouldn't consider it gambling. I wouldn't consider it all. Risk is really all about playing the game of mathematics. And again, there's many ways to skin the mathematical sheep. But I do think, as a whole, it is much harder to maintain, something like that over a long period of time by risking 5% or higher. Let's see here. Let's see here. 0.3% here. Very much more interested in getting experience down than making myself broke. I would think both. I would think you'd want both to be a goal instead of an either or. The other, Dry Desert says, the other side is, how much money will you make if you reduce the risk? Yeah, well, that depends on profit targets as well, doesn't it? Depends on payoff ratios. But it doesn't really matter how much money you will make if you have a mathematical fact that you're going to blow up your account now, does it? If it's a mathematical fact you're going to blow up your account, it doesn't really matter how much money you're making. Eventually, you're going to lose it all. So hopefully I answered your question. All right, last question I want to show you. I want to talk about a fourth model. I talked about the fourth dimension for risk. I want to talk about the fourth model. Doug says, you're assuming any trade is independent of another. The probability of winning a trade is independent of any factors affecting the market. Let me see if I understand. The probability of winning a trade is independent of any factors affecting the market. I'm going to disagree with that statement. That's why there's things called event risk. If a central bank's about to intervene, the probability of winning a trade is going to be very dependent upon what's happening in the market. If something occurs that causes a series of losing trades to occur, then one must wonder if the same factors affecting these trades and the probability of blowing up the account increases. Well, it's pretty simple. If you have a relatively stable distribution and good data set, then you should know, hey, where your boundaries are. Where's your first sigma, your second sigma for, hey, this is the number of losing trades we normally have in a general distribution of, say, 500 or 1,000 trades. So, if something occurs that causes a series of losing trades to occur, it's possible that your model isn't appropriate for that environment. That's why so many hedge funds lost money in 2008. Their models weren't able to algorithmically factor in that extreme volatility in the market. So that's why so many of them were losing. They were making loads of money before that, but as soon as the market went outside of, their sigma ratios, their standard deviations, they weren't able to deal with it. They weren't able to account for that. So it's something that has to be considered. Okay, there's a lot of other questions I'm going to try and get to, but I want to present one other thing real quick. Can anybody guess what the fourth dimension is when I talk about risk to reward? We talked about risk, reward, accuracy. Can anybody think of what the last one is? Wow. Let's see. Sequence of trade costs, skew and equity curve, lick. Enjoying your profit peak to trough. Good. 2 people got it. Tipcatcher and Gabriel. You. Time. We're going to explain about this. Has anybody ever heard of dynamic risk modeling? Or dynamic economic modeling? Yes, no? Let me explain how it works out. And I'm going to explain this using a system that we built. So we built a system that it's actually designed to take advantage of breakouts and volatility. So obviously the more volatile the market is, the better. We tested it all the way back to 2005. And I'm going to show you a picture of that in just a second here. Okay. So my programmer, his name's Jonathan Brown. I'll be happy to demonstrate tons of proof that it's him. But here is what we did is we tested it, we back tested it in a another program testing formula, and we back tested it from 2005 all the way up to about March 2011. Then we went on to programming it for MT4, and then we did our first month of live testing in October. Then in November, we realized we had to work on some coding things, improve execution, change a couple things. But we're going to be trading it live. We got about 200,000 pounds of money to trade it live with starting in January. We actually have about 3 million pounds to trade it with set aside, but we're going to test it live with 200,000 pounds because we've already demo forward tested it. And we're just finishing up the final coding of it, just to make sure everything's bulletproof. And then we're going to trade it live, 200,000 pound test. After the first few months, if it passes it, we'll bump it up to 3 million. So here's the statement. Jonathan Brown's my programmer. If you like, I'd be happy to show you an email folder with all his programming emails to me and things like that. I'd be happy to prove it to you. So here's the system that we tested live. It trades 5 pairs. It's a breakout system based on volatility. And here's how it played itself out. We started off with a $50,000 demo account over a few months. We started testing it live for a few months. I'll show you chart and figures in just a second. So hold on. Hold your horses. And so here's the performance of it. I'm scrolling down. Now here's what it did in October. This was about the second or third month of trading it, demo forward testing. It made $22,785. Okay, Esther, you're saying you got a white screen with no value. Is anybody else seeing a white screen with no value, or are you guys seeing it? Yes, no? Okay, great. Jano, you're saying MT4 is a different system time. Aren't you assuming that all MT4s have the same system time? Doesn't it depend upon its broker now? Doesn't it? So it's an assumption there. It's not an accurate statement. Many MT4 server time is based upon the broker time. It's not based upon MT4. So depending upon the broker, you can match it up with my IntelliCharts. Very easy. 99% of them, that's not true. Try MB Trading. There's one for you. Try FXCM-US. Different as well. So FX Pro has different than FXCM UK or Gain Capital UK. All right, great. Dry Desert says there's a 50% drawdown. Where do you see that? I don't know where you get your numbers from, Dry Desert. There's no 50% drawdown. No, there's no 50% drawdown, Dry Desert. You're mistaken. I guarantee. Take a look at it right here. Maximal drawdown, 7.1%. Here's the figure in the information below. So there's no 50%. It's 7.1%. Okay, profit factor 2.84, expected payoff. Oh God, give me 5 more minutes, please, Maud. I have to break through this. It's super critical, super critical. Okay. Anyways, take a look at this equity curve. You can see that inside a month, you're going to have periods of downward slopes in the equity curve, right? All right, great. So now I want to show you something else. This is the system over time from 2005. Okay, here's the new chart. So here's the system, goes all the way back to actually 2005. And as I said, it's a volatility system. From 2005 to 2007, it just chops around. Up 20%, down 20%, up 20%, down 20%. But then, once the volatility starts to pick up, look what happens from February of October 2007 on. Wins, month after month after month, in large amounts. And this is only risking 2% per day. It actually only has 1 losing month per year for the next 4 years. And it takes 100,000 and turns into, that is correct, 108 million. Now, here is what I was talking about in terms of time. What we realized is that we could apply a dynamic economic model to this. Instead of just risking 2% reward and 2% risk per day, that we could actually measure those changes in the equity curve on the individual months and say, okay, it's going at a downslope. This downslope went for X amount of trades and it went at X amount of angle. We can actually test mathematically that once the angle gets past a certain point and once the angle or once the number of trades gets past a certain point, we can now call that a new time window where we can adjust the risk to reward models. So we can make it a dynamic risk model, meaning we can go from, say, 2-to-1 to 3-to-1, or we can go from 2-to-1 to 1-to-1, and that could turn the system during that short period of time from having a losing week or a couple weeks to no losing weeks. So this is what is called, it's not scaling in. No, it's not a scaling in. That's different. That's different, Dry Desert. Completely different. No. It has nothing to do with scaling in. It's adjusting the risk at the outset. We're not adding any new positions. We're not adding positions as the trade goes on, and we're not taking as the trade goes on. We're changing it from the outset. This is called dynamic risk modeling. So instead of saying, hey, my system is 2-to-1 ad infinitum, we can measure the angles within those downward slopes on the equity curve, and once it gets past an X percentage, and it says, you know, after 3 trades or 4 trades or 5 trades, it's time to adjust the risk model to either we need to bump it up to 3-to-1 or we need to bump it down to 1-to-1. Does everybody understand that? What I mean by dynamic risk modeling? So we need to start looking at risk not just from first dimension risk, second dimension reward, that's 2-dimensional thinking, not just 3-dimensional risk to reward, which is including accuracy, but 4th dimension, which is dynamic modeling through time. So increasing the risk or decreasing the risk during those losing periods can increase the profitability. Does that make sense? Exactly. All right, great. Well, I have to wrap it up. I've gone over my time, and I apologize to Ed for doing that. Thank you for your patience and allowing me to explain this out. Hopefully, the takeaways from this are it's critical that you look at risk beyond 2 dimensions, that you really start to look at how accurate your system is, try and get a really good data set, see how critical it is not to take profits too early because that throws off the mathematics. Also understanding how much of your percentage at risk will expose you. And then once you have a really large enough data set, you start looking at dynamic risk modeling. So thank you very much for that. I got to get going. I want to bid you all adieu. Please stay on for the next webinar. Ed's got a really cool webinar coming up, so stay up for that one. And that's it. I bid you all adieu. Thanks again, Ed, for your patience. Good luck trading. And I will see you guys next time in 2012.